Sure, Marty. Thank you for having me. It's always nice to be here at your conference. I appreciate you inviting me to speak, invited me to return, and we'll hopefully make it worth your while. As President and CEO of Commerce Street Holdings in Dallas, Texas, we're the largest independent investment bank in Dallas. We have a broker-dealer that does deals, so we're very involved in the deal business in all sectors, but half of our business is in the banking sector. We're one of the top firms in the country in the banking sector. And so that involves M&A, capital raising in all sectors. On the investing side, we are in the OCIO business. We manage private equity funds. We've got several billion in SBICs that we sponsor. We manage retirement funds, and we also do some sponsored equity as well. So we do a number of things across a number of sectors. It gives us a lot of exposure and a lot of insight into a lot of areas. We certainly don't know everything. We love coming to these conferences and learning from others as well. Unlike Ed, I am not an economist, so I tend to kind of look at the economy in my country way of doing things. Being from a small town in West Texas, you can tell by my accent. Don't let it fool you. It sounds like Brooklyn, but it's not. So what I'd like to do is start off a little bit with the economy, and we'll talk about that for a little bit, then talk about different sectors, and then maybe some insights into some other asset allocations, what we're doing there, what we see, what our biases are, and then of course any questions that the audience may have, either online or here in person. And Marty always has great questions for me to keep me on my toes. Let's start with inflation. You know, we're going to have inflation numbers this week. And interestingly, the market's been kind of quiet about CPI and the expected number of 0.4 that's supposed to come out. So we will see what happens with that. Inflation has been pretty high. I think for the average consumer, they come back and complain that the numbers aren't really showing what they really are. I know when we go to the grocery store, the numbers look pretty high. But think about it cumulative. You know, if you've had since 2021, the last several years, cumulative, you know, inflation's eaten 25% price problem on what you have. And so those numbers are a little more in line with what we feel versus these single digit numbers. So think about it cumulatively. It's real, it's there, and wages are not keeping up with inflation. And for those of you who run businesses, I know even here at Commerce Street, I've got some of the young people coming and complaining, hey, here's inflation, how come my wages aren't going up? And I'm like, well, it's not my fault. You know, I don't control the economy. This is kind of what's going on. But it's frustrating people. It's frustrating our employees. It's frustrating your employees. It's frustrating the consumer even more so. So inflation is definitely very real. And as long as it's a problem out there, you know, you can expect the Fed is watching it. Now, the Fed, I had the chance to interview Michelle Bowman a few weeks ago at another conference, and she was very adamant about this, and Powell has been public about it, and that is they don't trust the numbers. They don't trust the numbers, and if you go back and look at the revisions, they're very large. And so they're using some gut feel and some insight as well. Unemployment, same thing. Unemployment numbers, you saw them last week. They're not as nice as you think they are. I want to read some negative things here about the inflation numbers, the unemployment numbers. Yeah, it's in the data. I think it's worth kind of going through. I just have to find it here, so give me a second. Well, first of all, unemployment is south of 4% for 25 months now. This is the first time this has happened since 1968. So think January 1968, 24-month period to January of 1970. And what's interesting about that period? Well, we had a recession start in December of 1969 with unemployment numbers very low. Now, I think that's where people get tripped up. They think unemployment's got to skyrocket in order to have a recession. It's not the number, it's the change. It's about the change in the slow in GDP. And I think that's very much what we might wind up with here. So keep that in mind. Let me see if I can find these numbers. Well, I don't know if I'm going to find them. I'll find them eventually, and I'll talk to you about them.
I got a quick question, Dory.
Yeah, go ahead.
Do they define the types of jobs, or they say they head of household jobs or like part-time jobs? I mean,
well, that's what I wanted to. I have the numbers written down here, and I can't read my writing somewhere. Okay, here it is. Yeah, here's. I think you'll find this interesting. The employment was down 184,000 jobs 3 months in a row. Okay, up 252,000 jobs in self-employment. So you hear what I'm saying? Employment numbers down 184,000, self-employment up 252,000, then wash those out. Doesn't that make you feel suspect about 252,000 jobs up in self-employment? That's got to be a big question mark. That's not normal. Non-farm wage and salary workers down 420,000. Full-time jobs down 187,000. That's minus 0.2% year over year. So unemployment up 0.3% year over year. So I think those are some things that got to get straightened out over the next couple of months, looking at this self-employment versus jobs. That's not a good omen. Anyone can kind of get on the internet and now say they're employed, they're self-employed, right? So I don't trust that, and I think we got to look at it. Now with the Fed, I was just visiting with Marty about this. I don't think they get enough credit for what they've done. They got a slow start out of the gate with inflation, but they've done a really good job of managing it so far. Now, no one likes 500 basis point rate hike, particularly in the banking industry. It created quite a shock last year, and we covered that of what happened in April with 3 bank failures for mismanaging their balance sheet, not credit risk in dealing with the rate shock. Having said that, we came into December and the Fed spoke very dovish, and the market took it and ran with it and thought we were going to have 7 rate cuts this year. That was a big question mark for me, and I thought it was a big mistake. I'm not sure why they did that. I grilled Fed Governor Bowman about that, and she agreed with it for the most part. They did make a mistake, but that's about the only mistake I think they've made in their messaging. They've been extremely clear in their messaging about what they're going to do. It hasn't been like Greenspan, where it's what we call Fed speak and mumbo jumbo, this, that, and the other. It's very clear in what they're doing. They're very hawkish right now. They're very higher for longer right now. They're very wait and see and look at the data right now. So the market's coming out. The market has priced in 100% rate cut in June and 4 cuts for this year. Well, that's not going to happen. How do we know that? Because the market's been wrong for 20 months now on all of these forecasts and timing on the rate cuts. And I suspect the market's going to continue to be wrong because the market is fighting the Fed. And we all know you're not supposed to fight the Fed, whether it be individual investors or the market itself. So I think we need to trust the Fed when they say something. It doesn't mean that they're right. It just means that's what they're going to do. I don't think the market can dictate to the Fed what they're going to do, even though it likes to. How can the Fed cut rates with inflation and GDP growing like it is? You don't have to be an expert economist. You don't have to look real deep. You just look at that. That's enough. So that's enough. Now, could there or will there be some rate cuts this year? I don't think we know for sure. I still think it's higher for longer. Wouldn't surprise me at all to have 1 or 2. Now, one of the fallacies that's out there is that we have to have rate cuts in order to survive. We're going to die. The market's not going to go up. Banking's going to get crushed. Real estate's going to get creamed. we have to have rate cuts. We do not have to have rate cuts. The market's doing just fine. What it needs is time to adjust to the new norm of rates being up a little bit. They may come down some, but they don't have to go down as low as they were. And I would argue for some industries, particularly banking, these rates are better off higher than they are lower. So the banks can adjust to this. They just need time. They don't need 500 rate point hikes or 300 rate point hikes in a 12-month period. Let's address some other areas. Let's start with what's going on in Bitcoin. Is there euphoria in the market? Obviously there is. I find it kind of interesting. A lot of pundits on Bitcoin are coming out with all these fundamental reasons on why Bitcoin is going up and this is it. And you got to get on, blah, 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 blah. I'm still not a believer that it's the replace gold or anything else as a currency just because someone says it is. I do think Bitcoin's going up because there are ETFs. ETFs are buying. When people buy ETFs, they got to go buy the Bitcoin. So I know there's a lot of disagreement out there on that opinion, but that's my simplistic approach. I don't know why Bitcoin would be the medium of exchange any more than a bar of soap. Who decides Bitcoin is the medium of exchange just because it has security or this, that, and the other? Maybe it's a lockbox of some other point. Who decides that? So I've not bought into it. I don't plan on it, but I am a big believer in blockchain. And I think blockchain has a big future, particularly in banking and in other areas. But I'm not big into Bitcoin yet. As long as governments are fighting Bitcoin as a medium of exchange for currency, which they are, then I think it's all for naught. AI is very real. And if there's been a blind spot in the market for the last 30 years, it has been technology. And AI is coming very, very fast. It's coming fast in our place of work. It's coming fast into every place of work. And it's going to get faster, and accelerated computing is the fastest thing we've ever seen. And it's pretty amazing. Now, where I think there's some differences, there's euphoria. Let's talk about Mag 7. Is there euphoria in Mag 7? Yeah, there probably is some. But having said that, we need to be very, very careful about it and look at it from a fundamental reason. And I've been doing this on the networks for the last year. And I think investment managers under allocate to Mag 7 at their own risk. Here's why. We got to talk about this. There's such a dominant force of the S&P 500. You have to allocate to it because that's where all the earnings growth is. That's where the earnings estimates are growing, not shrinking. Earnings estimates outside of Mag 7 are shrinking. So I like to call it Mag 6, ex-Tesla, because while I'm a big fan of Elon Musk, I'm not a big fan of buying Tesla because it trades on cult status versus fundamentals. The other stocks actually have some fundamentals to them. So if we go back and look at this blind spot of the market the last 30 years, you remember Amazon in its day didn't make money for years. It never had about a 5% margin to it. NVIDIA has a 51% margin and coins money. And it's doing it at an increasing rate. That's calculus, right? It's growing and earning money at an increasing rate. And its AI is a source of AI for the other Mag 6. So NVIDIA is very, very real. Does it warrant the price that it has right now? I would say it warrants the price that it has right now much more than Amazon did for 20 years. Is there euphoria in it? Probably. Yeah, I'd love to see it drop 20%. I'd buy some more. That's where the earnings expansion is. So you have to have an allocation to Mag 6, and you can tilt with NVIDIA, under allocate Apple, over allocate Microsoft, things like that if you want to outperform. But you under allocate Mag 6 at your own risk for portfolio allocation in your stock portfolio. You have to have that allocation because that's where all the growth is. And the market's bifurcated. The market has bank stocks, for example, priced where they were in 2009, and the banks are much stronger more capital, better underwriting than they were in 2009. Small caps have not rallied and performed as you would think. Well, they've rallied quite a bit, but the argument is they're much more overvalued than some of the Mag 6. Why is that? Because a lot of them don't make money. A lot of them are loaded up with debt. A lot riskier. So that's kind of where I am on AI and Mag 6. Oil, I think we need to watch out for oil. There's the competing discussion on demand for oil, for example, with China's economy the way it is, maybe cautionary recession signs. So people worry about the demand for oil, EV, et cetera. But long term, we still have big supply problems. So I think energy is still a really good place to be. And a lot of people have run away from it for ESG reasons, creating quite a bit of opportunity. But there's no reason why oil shouldn't trade in the $70 to $90 range all year this year. And within 5 years, we'll be back over 100. That could happen sooner rather than later. Forecasting oil is very difficult. But having said that, if you look at the fundamental supply reasons, there are issues for the long term to keep the pricing up for a good while. Banking, we have a very heavy focus in banking. I think it's important for everyone to understand what's going on in banking because it is the plumbing and wiring for the economy. Okay, so when we had rates move up, there were banks that evidently didn't know anything about history or asset liability management. They had long-term assets, long-term treasuries, like Silicon Valley Bank did, and some others. And when rates went up, the funding went out the door and costs went up, and they got squeezed and they went broke. It's that simple. It shouldn't happen. It's an elementary banking 101 mistake, and it's pretty unforgivable that not only those banks made those mistakes, but unforgivable that the regulators let them make those mistakes. It should not have happened. We talked extensively about that, and I think our last conference, but it shouldn't happen. Now, what about going forward? Well, banks are struggling with deposits because the market has been a good place to be for the investor, and people care about what they yield on their cash now. They want 5%. When it's below 1%, there's an indifference, right? And you under allocate and you invest. Now people care. So it's very competitive on the cash side, and that's made it difficult for banks. And it's really separated the banks that have control of the deposits versus those who don't. And those that have that control are more valuable and can grow, and those that don't have to slow down a little bit. The other thing is capital. There's still a lot of capital in the system, but there's going to be a need for more capital in the banking system, not because of credit issues per se, but for growth. Because a lot of banks in 2020, we had manna from heaven and free deposits. The banks grew, stretched their capital. The bank stocks went down because of the pandemic. And then when the market was very cheap with the rates, banks decided to raise very cheap holding company debt, increase their leverage then. And then when the market went south with the bank failures in April of a year ago, bank stocks went down. So they've been growing without adding capital. So there hasn't been a lot of bank stock offerings, public or private, in the last several years. And those capital ratios are the lowest they've been since 2008. 2008 numbers were lower, but these numbers are not where they need to be. They're getting there though. They're getting there.
Dory, would you say that there's no chance of contagion as there was in 2008? I mean, that because of the rules that were put in place, banks are very secure, and maybe the pricing is happening because people are anticipating something like 2008, or? Well,
I'll start with the capital levels, okay, because that's the key to everything. So, for example, the banks that failed in April, Silvergate, Republic, Silicon Valley Bank, and then the near failure but closure of Silvergate, all had 5% tangible capital at the holding company. You got to have more. You know, they need to be running at 8 to 10%. I'm an advocate of high capital levels for banking. And in fact, there's a lot of pressure for Powell to, I guess, from the industry to not implement higher capital rules, and he appears to be a little dovish on that, but I disagree with him on it. Particularly with these large banks that are too big to fail, they need to be running at 8% capital. They did so after the crash, but all those numbers came down extensively since 2020. So the money center banks had come down to about 5% at the beginning of last year, which I was very uncomfortable with. I would not get on TV and say that, but I'm uncomfortable with it if I was cornered. The numbers are higher now. They're doing a better job. They're getting higher. And I think they're trying to build those capital levels up. So that's good for all of us, but all banks should be running higher capital levels. So that gets to the contagion risk. So where's the risk in banking? They got to have the capital, first of all. Some do, some don't. Second of all, they got to have control of the deposits. Third, most importantly, they have to have control of their credit risk. Okay. Now, there's not as much credit risk in the system as everyone thinks. Everyone, if you watch TV, they'll say, oh my God, office space, commercial real estate, all these banks are going to fail. And so all their stocks trade really low. And that's a misnomer. Very few banks have that. Very few. Those that do, you can find them and you just don't buy them. There tend to be some of the larger super regionals, but that's about it. Most of that stuff exists in the CLO, CDO space, or in REIT, BDC space. Okay, so wherever it is, stay away from it. That office space is a real problem, no matter where it is. It could be in the best market in the country, in Frisco, Texas. It's still a problem. It's still a problem. Everything else, a lot of it, you know, is pretty good. And the underwriting for banking has been the best it's ever been. So I don't expect a lot of problems in the banking sector with that. Having said that, private credit has sucked up a lot of lending that the banks won't do. Think about it. Banks just got a tighter, safer box from 2008. So where's the rest gone? It's gone to private credit. So, you know, does that mean everything in private credit is riskier than what's in banking? No, but it also doesn't mean that it isn't riskier. Okay, so it depends. The answer is depends, and you got to look at it. We'll get more into private credit in just a minute. I do want to talk a little bit about China. I was on TV about a month ago speaking about China, and I didn't know they were going to put me on with another China investor. So he starts off and he takes off telling the audience on television how great China is and all these opportunities because it's so low, blah, 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 blah. And I thought, well, this is not going to end well for me. So they asked me about it, and I said, well, I think China's uninvestable right now. The market's down 50% over the last several years. The government's gotten tighter. They're running people off. They're squeezing control. The government's changing from a Politburo to more a party deal to a tyrannical dictator. Nothing looks, you know, unemployment is up. Every number you look at, construction, everything is bad. I think China is uninvestable. And then the number one lesson of credit that I learned in the 80s during the South American debt crisis, I had a Citigroup analyst tell me, we did all this analysis on whether they could pay. We didn't do the analysis on whether they would pay. And I think you run into that with China and some of these foreign countries, and that never shows up in your analysis. So I think they're uninvestable. So this 100% opposite opinion with this other guy on there, I thought, oh gosh, here we go. He's going to come after me. He totally acquiesced, and he said, you know what, I think the guy's right. Except for the banking system. The government's going to bail the banks out. And I thought, well, Well, now you're really in trouble because that's even worse. Just because the government bails out a bank doesn't mean they're going to bail out you. It means you get zero for your stock. So be careful of whose advice you get. I'm not saying I'm always right. I'm just saying sometimes people are pushing an agenda and selling a product. And I figure that poor guy's that's what he does. He invests in China, so he's got to sell China.
Hasn't like since 2008, the biggest, largest bank in Spain has gone under like 3 or 4 times? I mean, each time the equity shareholders, they lost all their equity.
They get wiped out.
Right.
Yeah, they get wiped out. And that's because people don't do a really good job of analyzing whether a bank's broke or not. And it's not that difficult. You take the assets, you mark them to market, give them another discount, and then mark it to equity. That's it. It's real simple. So we were just talking about, Marty, New York Community Bank. You know, is that bank broke? And from what I can tell, it's not broke. It had to mark its assets to market because of what it bought from the Signature deal from the regulators. But it's not broke, and the assets aren't all in trouble. Very different than the failures we had last spring, and that is why they were able to just raise $1 billion. And one of the ways you can tell is Steve Mnuchin is one of the investors. Now, if you remember, Mnuchin did the One West deal in 2009. I remember looking at the One West deal to invest in, and we turned it down. And the reason why is they didn't have a very good franchise. We like good franchises. But the math on One West was positive. So it actually worked. And it worked for Steve, and he made a lot of money. Of all the big deals that were done in the 2008 crash, all of them were negative except for that one and the small ones that we did with our fund. So we're one of the few people that made money. Steve made a lot of money because that was a really big deal. He parlayed it into a treasury job. Well, that's a sign. He knows how to do the math. The math is positive, so he invested, and the other investors invested. So that one's a very different scenario. It doesn't mean that they don't have issues. They've got some internal controls. They got some management issues. They have some mark-to-market issues as well, but I don't think they have a massive failure issue. Go ahead.
Right, and so you had talked about the super regionals having maybe some vulnerability, but you know, after Silicon Valley Bank failed, there was like a revolver account that was opened by the Fed for these banks to get money, et cetera.
Have liquidity and stuff.
Exactly right.
That closes this month.
But I gotta imagine if another crisis happens, it'll be reopened, right? Or
sure.
The Fed has buttons to push.
Sure.
Things like that.
Now, one of the things that we learned in this is, like I remember this like yesterday, I think it was 2009, reading the Wall Street Journal, and one of the FDIC regulators said, you know what, we may not pay for the uninsured deposits, on the next failure. WAMU has a $10 billion deposit run and fails in a week. I thought that was about the dumbest thing anybody could ever put in a paper or quote from a government side. Really stupid, because it's all about confidence in the system, right? You think about FDR, he's doing fireside chats. They pass all this legislation. They're trying to get confidence in the banking system. That's it. You get the Treasury job, you get sworn in day one. My job is to help install confidence in the U.S. banking system. Janet Yellen has yet to step up to the mic and say, your deposits are safe. Insured or uninsured. Bank fails, we move them over to another bank that has capital. Your money's safe. That's all you got to do. That's it. That's your job. Unless you have the IQ of a doorknob. And I'm extremely critical of that because that's the leadership of our country and it's our banking system. It's very important, and it hasn't been resolved yet. That question is still lingering. Am I covered on my deposits? I must have had 1,000 phone calls in 3 days from funds and whatnot, wondering whether they should move their money because they had over $250,000 in it. All Janet Yellen has to do is step up to the mic and say, your money's safe. We'll move your deposits over to another bank if the bank fails. And she can't figure out what her job is. All right. Let's talk a little bit about asset allocation and some of the different asset classes. Let's start with private equity allocation. Private equity allocations are growing, so is private credit. Part of that is on purpose. Part of that is extension, right? Private equity funds are now averaging over 5 years for the investment hold. Some of them are holding even longer. They're not having the IPO exits. We don't have an active IPO market, which, by the way, you need to have a really active IPO market in order to have an excessive bubble. We don't have that. You have to have a really active M&A market in order to have an excessive bubble in the stock market. We don't have that yet. So that tells me if there is some euphoria in the market, it's still early. Okay, it's still early, and it has a way to run. Remember, the irrational exuberance speech by Alan Greenspan was in February of '96, and took 4 years for the bubble to pop. Okay, so keep that in mind. But back on private equity, without the exits and the slowdown in deals that happened last year because of the price gap and the increased cost of debt, allocations increased in private equity, liquidity decreased in the market, and there was a huge decrease in the market last year in liquidity. And a lot of deals didn't get funded. A lot of people had trouble raising money. Ask the VC guys, toughest fundraising market in the last 5 years. And if you get money, what are you going to do with it? If you're a portfolio manager, what are you going to do with money? First thing you're going to do is put it in cash, because you get 5%. You get 5%. That's the first thing you're going to do. And you're going to do what? Over allocate cash, because you get 5%. Yes.
I think I have 3 questions. One is, what do you think about continuation funds? Because that's like something that evolved out of 2008, right? When everybody extended. 50% of VCs I talk to are going out of business. They're not, I'm not raising another fund.
Yeah, right? It's too much, it's too hard.
And the superstars are having problems raising money.
Everyone's having trouble raising money because, and no one's really talked about this liquidity crunch. I mean, it's as strong as it was in 2008 and 2009. It is a very big liquidity crunch because of this. And I distinctly remember raising money and going by to see everyone in the 2008 and 9 frame, and no one had any money because they were all over allocated. Same thing right now. So it's very, very difficult, and there's a lot of haves and have-nots. The good news is there's a lot of good strategies you can find if you look, and it's the ones that aren't as strong at marketing, right? And that tends to show up in what? Smaller funds. You know, KKR is always going to have a team of marketers no matter what quartile their funds are in, right? They keep 60 people employed in the capital of Oregon, make sure they get their $1 billion a year in allocation. But smaller people without the marketing teams can't do that. So yeah, you're seeing all kinds of strategies on continuation funds, particularly GP stakes, things like that. All make it very, very, very interesting. The private equity market is changing really, really quickly. There's an argument that there's too many funds out there. So there's consolidation going on as well. Some of these guys are actually buying together or merging together. And I think that's interesting. It's something that I don't know that we've contemplated a whole lot in past years, but I guess like any industry and any asset management business, as that industry grows and matures, there's going to be M&A and consolidation. But back on cash, that's an over allocation. Stocks, that's either an under allocation or an even weight, but the key is Mag 6. You got to have your exposure there. And it is a stock picker's market. It is a stock picker's market across the board. BC, again, very, very tough. There's probably an argument to go find, you know, the top quality VCs right now because there's going to be less competition for them over the next 5 years as they invest. But we got to have the IPO market open up. Hedge funds, most people, at least we continue to under allocate there because it's hard to find good managers other than Millennium and a few others that are good mainstays. but, you know, there's still an allocation for them. We tend to under allocate that and try to make it up with private credit, private equity. In private credit, we're extremely cautious because of our banking expertise, and we want to make sure that we're not investing in lower grade credits just because they can't get in the bank. They've got to have access. They've got to be able to get deals. We love senior secured lending, senior stretch. We're not big fans of PIK. We're not big fans of leverage, and we're big fans of groups that have been around and have staying power and a long-term track record. There is going to be problems in private credit at some point. One of the problems that we have in our industry is we know the 2 and 20 model isn't a perfect alignment of interest, right? Those of us that are on both sides of that, we allocate to 2 and 20 and we manage 2 and 20. We know it's not perfect for an alignment of interest. So having said that, we know also that the vast majority of private credit has not been super cycle tested. And so we'll see what happens on that.
Got a question on Mag 6.
Yes.
So what people don't know about Mag 6 is that you've got about 15 minutes. These companies have each one of them outside of Tesla has acquired, and NVIDIA have acquired 250 companies in the last 20 years each, right? So there's kind of a thought, and it's easy to do mergers and acquisitions, or easier when interest rates are closer to zero, right? Cost of capital has gone up. You know, these companies are cash rich, right? So I think it's a rocky road for that growth by M&A. I don't know. I mean, I think
that's one of the lessons that we've learned this last year, right? We think, oh, well, with rising interest rates, growth stocks will get hurt. And I think that would be more the case 20 years ago when you have an Amazon that didn't make money and a 5% margin versus NVIDIA that has 51% margin and coins money. I just don't think it matters as much. Those kind of performance numbers are incredible. I mean, think we as in forget it that it's technology. How often do you go screening for companies with that kind of margin, that kind of growth rate, that kind of cash flow? And they don't exist.
So you're very positive on NVIDIA.
I am. I'm very positive on NVIDIA. I was on Varney in December, and they were grilling me about it. They did it in December and January, and I had this same Mag 6 NVIDIA discussion. Well, NVIDIA was $398. Well, I can't. And Stuart saying, "Well, I can't buy anything that high." I'm like, I don't like that kind. I'm a fundamental value investor, and I'm telling you, it's a value. Am I telling you it's a value at 900? I don't think it's a bigger stretch. It's very difficult for me. The stock just run up. I'm praying it'll go down. I'm praying there's a correction. But I'll tell you this, I wouldn't bet against it on an allocation. Because the goal is to outperform everyone else, right? If you're going to outperform everyone else, you got to have that allocation. Back on real estate, obviously cap rates are a problem. We're still very active in opportunistic real estate and industrial warehouses, hospital or medical office. That's been very active. Some apartments, some retail, and we're skeptical, but we're busy. The opportunistic is building. Opportunities that are coming out of REITs, coming out of CDOs, things like that. One-off opportunities out of banks. We don't see a big, massive flow out of the banks, but there's some opportunities. But these distressed funds that go around and raise money, this is where the institutional investors need to be careful. That go around and raise money and say, oh, all these banks are going broke. We're going to buy all this stuff from banks and problem assets from banks. You need to invest in our $5 billion fund, $10 billion fund. You just got sold a bill of goods. You just got sold a bill of goods because that's not going to happen. A bank gets a call about every 20 minutes from a distressed investor, if not more. Hey, I'd like to buy your problem assets. Hey, I'd like to buy your problem assets. And it ain't happening. Banks have plenty of capital, and they don't want to take these big losses, you know. So even if you're Oak Tree and some of the other big players and Fortress and whatnot, you're going to get your share of assets, but you're not going to get as many as you sold to your investors. You're going to have to go get them out of other areas. If you sold to your investors, you're getting them out of banks. That's not going to happen. You're going to have a tougher time. And you're certainly not going to get them at the price that you told them you were going to get them. All right. You got more questions?
Too many distress funds.
I do think there's probably too many distress funds.
So
it's an excuse to raise money. You know, it becomes a hot thing. Oh, you know, we're scared, you know, look at you can take all these statistics on office space, but what they can't do is point to the exact banks on how much this is and how they have no capital and they're going to fail and they're going to be able to buy it. That's it. And they don't know that they'll get it. Even if the bank fails, they don't know if they'll get it. They don't know that it doesn't get wrapped up into another bank. This happened also in 08. Because you remember, everyone went around and raised money thinking they were going to be able to buy all these problem banks and problem assets. And for the most part, it didn't materialize. And one thing we know for sure is even if it gets ugly this time, really ugly, it's not going to be as bad as 08.
So in 2008, there was probably like 5 secondary funds bigger than $1 billion. Now there's like 30, and their scale, I mean, the largest one I think was a $70 billion secondary fund that was raised.
It's amazing. Yeah. We all like secondary funds. We all like secondaries. And I think that's, again, a sign that the market is maturing in private equity because it's developing such a liquid secondary market. You know, I don't think I've ever in 30 years not been able to get rid of a limited partnership interest on our part or for a client, a good or a bad fund, small or large investment in less than 30 days. It's just been there. And I think it's getting more and more liquid. And another sign that we're seeing for this is what? The big push to retail. Retail investors in private equity, private markets, and private credit, it's growing. You know, through ICAP and whatnot, you can get these investments as small as 100,000, and they're getting better and better at it. For a long time, you got poorer quality alternative assets in retail, and now you're starting to get better quality in retail, and that's interesting.
And the secondary funds have to allocate. I mean, they're on a time schedule, right? I mean,
they're on a time schedule, and they're selling what? Less J-curve. So they got to invest. They got to buy. So they'll pay that premium for an LP interest if that's what they got to do. They're not going to send the money back.
So you're overall more positive, yet you're saying be selective.
Be selective. I am. I don't think the market's going to crash this year. It could. We have some corrections, 10% or whatever, maybe 20% at the worst. I don't see a 50% crash unless we have some kind of crazy event or something, which could happen, right? I mean, it is an election year, so expect the unexpected. That is going to happen. You know, whether it's accident or manufactured or what, expect the unexpected. But I don't see all the bubble signs in the market that everyone's worried about. Now, it doesn't mean that we don't have multiple expansion in the market. We do. And the multiple expansion is much higher than what the earnings expansion is. That's not a good sign. But we don't have the crazy IPO market. We don't have the crazy M&A market. And we have fundamental reasons why this big tech is trading the way it is. It's not all hype. I mean, if you remember the .com days, you remember how crazy that was. I remember printing a page that showed up on Bloomberg for an IPO of a company that said, we have no earnings or no revenues and don't expect any in the near future. And they'd gone public. I remember printing that page going, this has got to be the top. And it was. We don't have any of that. Heck, we don't even have an active IPO market right now. This will be really interesting this week. We got Reddit coming out, right? that's going to be interesting. Does that pave the way for some more exits and some more liquidity in the market? The market is just dying to have some exits for its VC and private equity funds. And that would be a good sign. When that happens, if and when that happens, then I think you can go, okay, we've probably got a 12 to 18 month runway, depending on how crazy it gets, before we see what's going on. So I wouldn't under allocate a lot to the stock market right now either.
So I guess yep.
I was just curious, what's your concerns around liquidity going into this year?
Yeah, well, from a banking perspective, it's a lot. So we had this discussion the other day with a CFO of a bank who's 40 years old, and he's a very, very talented CFO, but everybody has perspective. So banks have been running at very high loan to deposit ratios over the past 15 years because rates were really low on cash, right? And banks can't make money on 1% cash. So they've been invested with high loan to deposit ratios. So he was saying, well, what do you think is an optimal loan to deposit ratio? I'm like 70%, maybe 75. And he thought I was nuts. I'm like, well, you don't understand, for the previous 50 years before 08, that's what banks used to run at. Because why? They made a spread off of securities, not as much, but they made one, and they made a spread off of cash. And you can do that today. You put it in 5% cash, you loan out a 3% deposit, you got a 2% spread with no risk. You know, that should be a part of your portfolio. And given the fact that we lost over $42 billion in 8 hours at Silicon Valley Bank, you got to be worried about run risk a little bit. So I think liquidity will continue to be a problem this year because of the asset allocation reasons we talked about before, and the banks being really tight on credit and readjusting their balance sheets. We got another year's work on all that, because the banks are just like these family offices and foundations and whatnot. Put it in cash. Just put it in cash. All the money that's coming in, put it in cash. I want to over allocate there. I want to over allocate my securities a little bit. I want to bring down my loan to deposit. So I think liquidity. Now, having said that, if you go back, because I remember this like yesterday, in late 80s, early 90s, there's no liquidity, zero. There were no private equity funds out there, private credit funds, all these different things to add liquidity to the market. So there's still a lot of liquidity in our system, but it's just not as much as it was.
Dory, since we're in Texas, how about do you see some of the upside and downside in Texas in the next 2.5, 3 years?
Yeah, Texas obviously is got a lot going for it. I mean, someone came to me to our firm with a nice tall office building in Frisco on the toll road. You know, one of the better spots in the world, right? Building's 15 years old, 90% leased. And the guy was trying to raise equity for it. I took it to our real estate guys. I'm not even going to look at it. There's no equity for that. And I thought, holy moly, what if that was in San Francisco or Detroit or Cleveland or something like that? You know, we can get that done in Frisco. That's still a tough market. So there's still some things that are going to be tough here in Texas, but I'm more bullish about Texas than I am any other economy in the world. It's a good place to be. It's a good place to be. Having said that, in some ways, we're the prettiest horse at the glue factory, right? Because everybody's got problems. Everyone has problems.
Is there too much growth?
Is it too much growth? That's all about leverage, right? That's all about leverage. So, like the private credit, I worry about, you can be underwriting really good, but if you're too levered, you know, that dries up when there's a liquidity. That's it. I mean, people that are buying into levered private credit don't realize how risky that is. That's a capital markets function that can go away in a second.
More questions? Great job, Dory. Thanks so much.
All right, I want to close with one thing real quick.
Yep.
I think it's really important to do this. I want to give a nod to virtue out there. And I want to bring this up. It's very, very important when you're in this business that you impart virtue in what you're doing. When I first started in the bond business, you traded millions and millions of dollars on your word on the telephone. And you still do that today. And if you messed up a trade or did something like that, you were drummed out of the business. I've been very blessed to be in this business a long time, since the 80s, and deal with a lot of virtuous people. I bring this up because I do think we have a problem in this country and leadership and whatnot in Congress and DC with virtue. And it reminds me, I was watching a show a number of years ago, retired CIA agent. The reporter asked him and said, "What's the most dangerous thing to this country?" He said, "Oh, that's easy. We study this at the CIA. And everyone knows what the most dangerous thing to this country is." And he says, "It's one word." He said, "What?" "Lie." The lie is the most dangerous thing. When you think about what Lincoln said, Lincoln said, "For if destruction be our lot, we must ourselves be its author. As a nation of free men, we'll live through all time or die of suicide," because no one could invade the U.S., right? Even though we're kind of being invaded on the border, but no one could really invade us. So we have to be the author of our own destruction. And I think that starts with the lie, and it starts with virtue. I love dealing in this business because most people are very virtuous. I just want to remind people that it does make a difference. When you're virtuous with each other at home and in your community and with each other in business, and when you're lobbying, then that is a reflection and will take hold, and it does make a difference. Thank you very much.